Namibia, a land of contrasts. As one of the top 50 largest countries in the world, it's also the second most sparsely populated nation with only 2 million people. But despite its small population and harsh climatic conditions, Namibia is a country rich in resources. It's the world's 6th largest diamond producer and recently revived its uranium industry, making it the 2nd largest uranium producer in Africa after Niger. Agriculture is dominated by the beef industry, but there are inroads in the north where government is ploughing in money to improve food security into what is mainly a subsistence farming area. And while the country celebrated its independence from South Africa some 20 years ago, it remains tightly connected to the Southern African powerhouse, making it vulnerable to economic and political disruptions there. Like other commodity-driven African countries, Namibia faces a challenging year ahead. Economic growth is expected to slow to 1% this year, as the global economic growth rate drops to 0.5%. And this slowdown means the country's 2 top foreign exchange earners will also see a loss in revenue. The heaviest blow will come from the diamond industry, where output is expected to halve this year, and analysts say by 2010, production will come to a halt.
Namibia as an exporting country, I mean, we're still an exporting country. We export diamonds, we export uranium and copper, for example. And all the prices for those commodities actually been affected simply because there's no more demand for as high demand as used to be for those commodities. And obviously now not having that demand, we'll start producing less, and therefore the economy will start growing much slower than it was doing before.
There are 2 drivers for this lower economic growth rate, and the one is especially the diamond mining industry. De Beers Marine already indicated that they will basically terminate the offshore production for at least, I think it was initially indicated up to the end of February, and I think there are indications that that will continue based on what's happening in the rest of the world. And the other one is tourism, and as you will understand is that holidays is the first item that you will cancel and cut out of your budget when you are under financial stress.
And of course, this loss in revenue impacts the country's reserves.
The way we measure our reserve, whether it's sufficient or not, basically is more in terms of our currency bag, because in terms of our currency bag, we have to keep, sufficient reserves to cover our domestic, issued money in circulation, which is, is sufficiently covered. We're talking about our reserves now at $14.5 billion.
Namibia earns 20% of its budget revenue from the Southern African Customs Union's pool. But South Africa's Finance Minister Trevor Manuel says countries need to buckle up, as South Africa's transfers to SARCO members will drop by 1 billion rand this year. To help stimulate the economy, government will continue with its infrastructure plans and aims to increase civil servant salaries by around 25%.
Fortunately, the government will be fairly expensive. We expect, that amount that they want to spend additional on salary increases will be roughly 3% of GDP. So, and basically that will get the economy to a positive growth rate. If they would have continued on the fairly conservative approach of the last couple of years, then we would have been in serious trouble. What is worrying is that that salary increase is not a once-off story. I mean, it has a permanent impact. So basically, they have to fund that 2 billion plus in the years to come. So revenue is obviously a big challenge for them. On the diamond side, for instance, if you just look at the amount that the government received from diamonds in terms of revenue, royalties, and dividends, which is around 800 to 900 million. And I think we can expect at least a 30–40% decline there. So you can imagine that the fiscus will be under fairly large pressure. And then you have SARCO as well, the SARCO revenue pool. Trevor Manuel already indicated that he's a bit concerned on what's going to happen. He specifically referred to Lesotho, not so much in Namibia. But I mean, the SARCO is our largest source of revenue. Last year it was around 8 billion. I think it will be about 5% lower this year.
And another major concern is that while this income from SARCO is at risk, Namibia also faces a tough decision in terms of its trade agreements. If it signs the economic partnership agreements with the European Union, it risks threatening trade ties with South Africa.
Currently, most of our production goes to the EU. In the case of beef, it's around about, let's say, 80% of value. In the case of grapes, everything's going to the EU, minerals, most of it, and most of our fish as well. The main concern, which was initially put on the table, is the fact of regional integration. If you go back to the Cotonou Agreement, where it gives you the blueprint of how the EPA should look, it specifically states in 2 articles that the EPA should build on existing regional integration initiatives. And in Southern Africa we have got 2. The one is SADC and the other one is SACU. Now SADC is already split in 4 because of different configurations where the countries are negotiating EPAs with the EU. Now the second one on the fire at the moment is SACU. Now if you go through with the EPA, then you go against what was proposed in the Cotonou Agreement to enhance regional integration, and in this case it will just precisely do the opposite. The most favored nation clause, that's one of the other problems. It means that in any case where SACU as a group negotiates a preferential or free trade area with someone else, automatically the EU will benefit from that. And I mean, it's a question of you are doing something now that you can benefit in the future without doing anything. I don't think that's fair against developing and African countries in particular.
But it's not all doom and gloom. There might just be some relief in the commodities sector. Uranium is one resource where there is still global demand as the world moves away from fossil fuel energy sources.
There is hope because as you might know, we are the 3rd largest country in the production of uranium, and we have quite a vast deposits in this area, although the prices again are affected like of other commodities.
There are areas, pockets of optimism, particularly in the uranium as well as gold areas. We are looking at these sectors with great interest. Secondly is the area of infrastructure. The Development Bank and other financial institutions in a consortium supported a $3 billion worth of project in terms of power generation. In preparation for the upturn, there was a groundbreaking ceremony of a major cement plant that will be producing 700,000 tons of cement annually. It's an investment again of 2.5 billion Namibian dollars. Later this year, we'll probably see an announcement of some 4+ billion Namibian dollar worth of investment in the uranium sector.
The uranium space in Namibia is dominated by 2 players, Rio Tinto and Paladin. Paladin owns a major share in Australian-based explorer Deep Yellow, who says its financials are sound and mining uranium still makes good business sense.
We got to a stage where uranium went down to $6, which wasn't sustainable. So for 30 years, no exploration, 25 years, no new uranium mines were built. So if you look at the industry is old and tired. There are not many new mines. So as I said, Langheinig was the first new conventional uranium mine started anywhere in the world in the last 25 years. There's not technology available, so engineering, all that side's a problem. If you come to what's sustainable in a price, you don't need $138. The long-term price at the moment is between $75 and $80, for our scoping studies and feasibility work use a price of $65 US. Just like gold, if the gold price is $1,000, you can probably work a gram of gold. Uranium is different because it's a long-term supply, so you can't just make uranium for no reason, because what do you do with it? So that's why a lot of the mines closed when the uranium industry collapsed, because they didn't continue. I'm talking about the 70s and 80s, because they didn't build more nuclear power plants.
The central bank in Namibia is quite strict in its regulatory requirements, and then the banks themselves as well. In particular, our bank has the this particular reputation of being fairly conservative in its lending policies, which I think has come to stand us in very good stead at this point in time. That our non-performing ratios are well below industry standards. We have no exposure whatsoever to these toxic assets internationally at all, and that's why we remain unaffected by what has happened internationally.
There's a domestic asset requirement for banks of 90%, so it means that 90% of the assets of banks must be in Namibia. So you're only allowed to have 10% out of the country. So they're pretty much involved in the local economy.
The consensus is that the financial services sector is sound and will stay that way. And the Development Bank of Namibia seems to agree, which is why it's looking to increase its loan book to over 1 billion Namibian dollars this year and is ploughing in over 42 million into the micro-lending space.
Here we are not looking at those microfinance that are for consumer orientated, but for useful kind of developmental impact analysis, and that is with regard to enterprise development, housing, education, renewable energy, and so forth.
While the stock market might not be as vibrant as its South African neighbour, local Namibian stocks have performed remarkably well compared to their South African counterparts.
Well, it was started in '92, just after independence, and it got a boost in '94 when Regulation 28 was amended to force pension funds to buy stocks on the Namibian Stock Exchange to comply with Regulation 28. And it ticked along quite nicely until, and the statistics that I've extracted for today, we started in 2000. We had quite a boost through a company that subsequently went insolvent, Namco, and from 2003 we had a phenomenal growth of 280% until the 11th of October 2007, and since then the market has now decreased by 50-odd%. So our growth from 2003 to 2009 is 105%. The local stocks, however, have grown a lot better than that, and they've gone up in leaps and bounds. Even with the financial crisis of the last year, the local stocks have shown resilience and haven't shown any declines at all.
And even though South African industrial conglomerate Bidvest expects a tough second half in 2009, it says it's still got plans to list on the Namibian Stock Exchange. Meanwhile, one local Namibian financial services company that's spreading its wings is Trustco. With a market cap of $51 million, Trustco is the fourth largest listed company on the NSX. The company specializes in everything from property and education to microinsurance. And in a country as big and as sparsely populated as Namibia, diversifying your business is certainly the way to go.
Namibia is a very large country, but it's got only 2 million people. And in Namibia, basically, to do a business just in one sector, we think there's an inherent risk in it. Say, for instance, you're only in the agricultural sector and it doesn't rain. What do? Your whole business is basically under threat. So, firstly, we've diversified, and secondly, our business is really dovetailed. The one fits into the other.
Trustco was the first company to list on the JSE's New Africa board as part of its expansion plans. It sold 65,000 shares within the first 3 minutes of trade at a price of 72 cents. Namibia Breweries is one of the blue-chip companies on the Namibian Stock Exchange. Last year, it recorded a 27% increase in revenue to total 1.3 billion Namibian dollars, proving it's able to hold its own in a market dominated by global giant SAB Miller.
Obviously, SABM is a formidable competitor, which we respect. But yes, we had some great successes in their markets. Let's use, for example, South Africa. Our Windhoek Lager brand is doing fantastic in South Africa. With the creation of our JV in South Africa, Brand House, with our partners Heineken and Diageo. The team down there have done extremely well and has grown the market share of Windhoek Lager. Obviously for us, yes, to come back to the competitor, one thing that we are very proud of, and it's our unique selling proposition, is that we brew according to the German purity law, or named the Reinheitsgebot, and where we only use malted barley, hops and water, nothing else. And yes, and that we tell our customers and consumers continuously. Our biggest market share we hold is in our local market in Namibia, and we're very proud of that. We're working hard to continuously grow our market share in Namibia as well as our neighboring countries. Our number one export market is South Africa, where we compete heavily in the premium beer sector. We've had some great successes and we continue to have some great successes there. Then obviously in Botswana and Angola, which is also, we've grown our market share tremendously in those two markets.
While the Namibian market is the company's major revenue earner, it's still very small. And that's why the company is focusing on increasing its export market. Already, it exports to 27 countries globally.
The manufacturing sector in countries like ours is quite a challenge. It's a challenge because of the limited market, but those who succeed are those who have an export orientation, those who have an outlook at broader regional market, as well as the market beyond the region. And Namibia is well positioned in that regard.
Export is important for us because as a Namibian company owned by Namibians, it's important that we continue to export to generate foreign income to the country. We know that for every $1 NAM dollar manufactured in Namibia, we generate 2.62 NAM dollars back into the economy. So export, unfortunately our government has been supporting local companies, manufacturing companies, to find export markets in Africa.
But as regional governments try to increase revenue sources in these tough times, the company is seeing profit margins come under pressure.
We've seen some drastic actions by governments taken. For example, in Botswana, the government has introduced a 30% levy or sin tax on all alcoholic products, from wine, spirits, beer, etc. So it's still early days. It was only implemented November 2008, so it's still early days to see what is the impact. Challenges include high distribution costs. As you rightly said, we import all our malted barley hops from Europe, which, yes, it does add to cost. We distribute the majority of our products now to South Africa, which does add cost to the entire supply chain. But so that is one of the key issues. But fortunately, the fuel price has come down, which is giving us a breather. But also, as a team, as a management team, we've got a critical success factor called the war on cost. And so for us, we're extremely cost conscious. Make sure that we spend wisely. We've got hedging policies in place, contracts with suppliers, and that should help us through the tough times.
Government has put some incentives in place, like a 10-year 18% corporate tax rate for manufacturing companies, after which they have to pay the standard 35% rate. And with the influx of South African goods, government has had to put policies in place to protect local companies. Namib Mills started out as a small milling operation in 1982, producing staple products like maize meal.
We are basically in staple foods as such. A lot of the people in the north are subsistence farmers, and they produce mahangu for own consumption. The past number of years, the mahangu crop was not as good as it should have been, so people are generally then forced to buy maize meal. And this year specifically, we're selling quite a substantial amount of maize meal, not only in the normal business situation, but there's also world food programs. And then the government has also introduced a drought relief scheme where they issue maize meal, vegetable oil and canned fish. So we've, at this stage, are really having an excellent year as far as that's concerned. Obviously there has been price increases, but people must eat, and you find that people within, say, drop their standards and eat down, as we say, from, for instance, a super maize meal, maybe to a special, from a special to a sifted, and from a sifted to an unsifted. But we are picking up in volumes as far as that's concerned, and then we're also exporting quite a substantial amount of maize meal to Angola, because they've also had bad crops in Angola. In the case of maize and wheat, there is control. So you can mill in Namibia, but no milled maize or wheaten products can be imported. So that's really a closed border situation. And even if during the production season of maize and wheat, the millers have to buy the local produced maize and wheat before they are allowed to import maize or wheat from anywhere else. And the Namibian Agronomic Board is controlling that. So maize and wheat, no imports really that can compete with us, but anyone is free to come and mill here. We, for instance, I think have something like 26 maize milling licenses in the country.
And even though Namibia is hardly the country you'd associate with traditional Italian pasta, the company has expanded into just that.
It's a related product, and we were doing quite well from the start. I believe, I wasn't here then, but I believe that they captured about 50% of the market before the infant industry protection was introduced. At this stage we supply about 95% of the market, but again our competitors, Pacomo, is coming into the market.
While some companies are benefiting from government control, others say it's customer loyalty that will help them survive in the current global conditions. And Weermann Brock is one company that knows how to survive. It's been around since the German colonial days and is still run by the same family.
I'm the sixth generation in the family. It's a family business. We started off in Germany in 1837. That's when my grandfather decided to move to Hamburg, and he started with trading in goods. Later on he decided that the trading of goods is not good enough any longer. He bought ships, and then he started to trade all over the world, concentrating on Africa. And that's how we started in Namibia in 1894, so that's now 114 years ago that we started in Namibia. And originally it was as trading posts, supplying goods from Europe to Africa, and also trying to export items from Africa back to Europe.
Like larger neighbour South Africa, Namibia has suffered from high inflation, but sees this easing in the course of the year. With job cuts in the mining sector and pressure from a slowing economy, spending patterns are likely to reflect the tough times.
The inflation of the last year was quite tremendous. Basically what happens is people are down trading. The person that used to buy his fillet steak is now only buying mincemeat. The person that used to buy his mincemeat is now only buying bones, and the person that used to buy the bones now can only afford the bones once every 4 weeks instead of every week.
But Namibia still has a lot going for it, and one of the major plus points is access to the Angolan market. Coming out of a 27-year civil war, Angola is rebuilding itself at a rapid pace, making it the fastest growing economy in Africa. And this growth means more people who have more buying power, and this means a demand for goods from Namibia.